Goetti, founder and CEO of HG Research, joins us from Singapore now. Hans, hi, good afternoon. Thank you so much for making time for ET Now. First up, let's begin by talking about the market itself. Now, we have corrected almost 10-15% from the recent highs, and even globally, we have seen quite a bit of correction for equity markets. What is the overall outlook for global equity markets as far as calendar year 22 is concerned? After the splendid 2021, should we moderate our expectations for 2022?
That's very unlikely, because what you had last year was a combination of very positive factors. For one, we had monetary policy in the US and everywhere, which was very supportive because of the stimulus due to COVID. That's going to go away. And fiscal policy is the same story. We had tailwinds last year, and we're going to have headwinds this year. So with inflation going up, and by the way, inflation is supply induced, central banks raising rates to combat inflation into a weak economy. So that is it's a possibility that we're facing a recession in the latter part of this year, and that does not necessarily bode well for equity markets anywhere in the world.
Let's also talk about emerging markets versus the developed markets then. Which emerging markets are you interested in at the moment? Where do you see India positioned among others?
Well, we're very cautious on equities in general, and I would say that includes emerging markets. What speaks for emerging markets as opposed to developed markets are the valuations. I mean, emerging markets are extremely cheap compared to the US, or, well, especially the US, I would think. So that in the long run should benefit. But in the current environment, where we're having, instead of a risk on, we have a move towards risk off, let's say in safe havens like the dollar, like gold, and so on, there will be further downward pressure on emerging markets, and that would include India. Now, within emerging markets, I think India is, in the long run, is well positioned, but India is also facing the same problems as the developed world, like rising oil prices, rising inflation, and the central bank, who is essentially between a rock and a hard place. Are we going to raise rates to combat inflation? Yes. If we do, we kill off the economy, and if you don't do anything, inflation will go higher. So it's a bit of a dilemma here. So for now, I would say safe havens make a lot more sense than equities in any part of the world, as I said.
Okay, so you're saying that Fed is between a hard place and a rock, but similar is the situation for the rest of investors, right? You are like sitting on cash at the moment, or you're investing in other asset classes?
Okay, I think where we put our money is, if you want to be in equities, you're never 100% out, so you would have to be underweight equities. But if you go in there, you would have to look at, let's say, mining, gold mining. You have to look at energy. And given the fact that we are facing the possibility of a recession, you want to be in stock groups that do relatively well in times of recessions, like consumer staples, like utilities, like healthcare, which are relatively independent from economic cycles. So I think defensive industries may be more cash than usual. And I would also think that US Treasury bonds make some sense here. I mean, you get some returns, but it's more of a defensive move rather than something that you would want to go for big capital gains.
Right. Commodity prices have, of course, been going up. They've been on the rise. What is your review over there? How can it impact margins of companies across?
Well, with the current situation, with the war going on in Ukraine, you see a lot of upheaval everywhere. You see oil companies pulling out of Russia, so there will be less investment in energy. So essentially, commodities are going up everywhere. And I think those commodities which have the biggest impact are really food and fuel. So you have food prices will continue to go up. Fuel prices will continue to go up if you don't have a solution in the Ukraine, a political solution, hopefully very soon. But in the absence of that, you will probably continue to see relatively elevated oil prices. So energy stocks are really not quite reflective of these oil prices that we have yet. I think there could be some upside potential there.
that point is taken, but you know what? We have been going through a lot of these important cues. We had first COVID, then it was all about what Fed will do, and now we have this geopolitical tension that you just alluded to. What are the key triggers you think that are there for global equity markets as we move into 2022?
Okay, well, let's assume and hope for the best that a political solution can be found for Ukraine. But you know, this whole thing will reverberate for quite some time. I mean, Russia is essentially made into a pariah state. We have now a new Iron Curtain, and that will take time to resolve. What the resolution or the end game is here is very much in the dark. So that's one thing we have to consider. And the other thing we have to consider is that the economy, even before the war in Ukraine, was already starting to slow down for reasons mentioned. The lack of fiscal and monetary stimulus, which we had last year, as I said, it's not going to be this year. It's not going to happen anymore. So we had a slowdown already. So I think that we are in some kind of a bear market right now, interrupted by possibly very sharp counter-trend rallies. If you have a political solution in the Ukraine, for instance, you will probably see a rally of 10, 20% easily, but that doesn't mean it's sustainable. That's the thing. I mean, you can have these rallies from oversold situations. So if the one strategy would be to sell into these rallies, lighten up positions more, and position yourself in, as I mentioned, defensive sectors.
Very interesting take there, Hans, talking about how we continue to be in a bear market, and if you see a 10-15% rally, that should probably use as an exit opportunity and booking some profits. Thank you. We'll let you go on that note. Appreciate your time today. Moving on.